is like shopping for deals, but instead of shopping for a new laptop or a new phone, you shop for stocks. There are essentially 4 key steps to value investing. First, is you look to understand the business that you invest in. You wouldn't buy a business in your local town before you fully understood the business. Its internal components, how it worked, its product, how it makes money, the management. Who's running it? The same idea goes with a stock. So stick to businesses that you are capable of understanding. This is different for each investor. Some investors will understand gaming stocks more than others because they game themselves. Some investors will understand consumer stocks like Walmart or Home Depot because they shop there often and know which stores are better. Every person has a different set of expertise and group of stocks that they can understand. Once a value investor understands the business, secondly they look for ones that have a competitive advantage. What I mean by this is they look for businesses that are not easy to replicate, they have things about the business that helps them beat their competitors. Whether it's Coca-Cola's advantage in that everyone knows Coke and loves it around the world, or Canadian National Railway's advantage in their infrastructure setup and railway lines. Place. Another railway line would struggle to compete because they would have to build a whole new railway across Canada just to start competing. Third, a value investor wants management with integrity and talent. Others are the ones running your business and controlling the day-to-day environment. If your manager is rotten, this will leak through to the employees and the business itself. Lastly, value investors pay a price that makes sense. One where the long-term value of the stock is better than its price. You wouldn't pay $100,000 for an iPhone, even though it is a good product, but you may pay $1,000. You would love to pay $100. When it goes with a stock, you wouldn't pay a ridiculous price for a quality stock. But you would pay a fair price or a cheap price. Some examples of value stocks include Warren Buffett's investing firm Berkshire Hathaway, Micron the chip company, Alibaba the Chinese e-commerce stock, Meta, Suratage Growth, Occidental Petroleum. Dive deeper into these stocks if you like the idea of value investing. And if it makes sense to you. If it in investing is another way you can play the investing game, if you are a fan of consistent income, you don't want to wait for stock's price to go up, you just want consistent cash flow, then consider the strategy. Essentially, when a business/stock makes money, they have 2 key options on what to do with it. One is they can reinvest that money back into the business and look to grow it. The second option is to pay out those earnings to the owners of the stock. This is called a dividend. Normally, dividends are paid out quarterly, but you can also find ones that are paid monthly. A big thing to watch out for though with dividends is consistency. Some stocks will always pay their dividend, some stocks or a session will come, their business will get hurt and they cut their dividends, they're inconsistent. One way you can mitigate a potential dividend cut is by buying what's called dividend aristocrats or dividend kings. Dividend aristocrats are stocks that have consistently increased their dividend each year for 25 years or more. These include IBM, Exxon, Chevron and General Dynamics. Dividend kings are stocks that have consistently increased their dividend each year for 50 years or more. These include Coca-Cola, Colgate, J&J, P&G and a range of other quite mature companies. These stocks, as history shows, are very unlikely to cut their dividends in a recession or in tough times. They haven't done so for 50 years. Some good dividend investors to follow are Dividend Sensei on Seeking Alpha or PPCNN. J.J. Buckner on YouTube. If you're lazy or not even just lazy, you just don't have the time to go about researching stocks, then you may want to consider passive investing. A lot of beginners think passive investing will not get you good returns, but this is untrue. Passive investing in index funds actually beats 83 to 95% of active money managers. So let me quickly explain what passive investing is. Passive investing is when you buy large groups of stocks called index funds or ETFs. Instead of actively picking out individual stocks, you can buy a whole group of them. For example, you can buy the S&P 500, which is 500 very large USA companies. Or you can buy technology index funds if you think that sector will do well. Or you can buy emerging market ones or energy ones, or depending on the sector that you like. ETFs and index funds are a really good way to diversify your portfolio and spread your risk. In fact, this might interest you. Warren Buffett recommends that most investors adopt passive investing in index funds instead of other strategies. I am happy to tell people the same thing I've told them before, but They'll never get to see most of them. But if you do, that's the most, first thing to do, if you want to invest for the long term is index. And it's the S&P 500 index. Let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75, create 3 shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure to what it would be worth today. Oh man, the answer is about $400,000. This investing strategy is for the more illustrious type. The guys who don't mind a little bit of risk. It's like the attacking style when you play a game of chess. Growth investing is where you invest in companies that have more risk to them, yes, but have more potential on the upside. The innovative stocks, the technology stocks, the disruptive stocks that are changing the world. The Teslas of 10 years ago. And growth investors have done very well over the past decade as the world has changed and as technology has spread. Growth stocks like Amazon, Apple, Tesla, Netflix, Alphabet, and Matter all shot up like a rocket. The key with growth investing is to weed out the good growth stocks with a proper business model from the junk, because there is a lot of junk. Also, you want to try and invest at the start of the bull market instead of at the end of the cycle. And this is why I'm kind of a little bit wary of growth investing at this point in time, as we have experienced already a long bull market and that bull market is going through some turbulence, we can say that in the least. Cathie Wood, Chamath Palihapitiya are 2 investors who do follow a growth-oriented style of investing. Although they did well to start with, they have struggled a lot this year, especially Wood. As we can see, her fund ARK Invest started with a bang, but it is now broken even. It's at the same price that it was a long time ago. Be wary when you adopt this style of investing, because this style